As generative AI takes the world by storm, one sector which is seeing unprecedented change is finance. As AI stocks like NVidia run 21% higher, and a growing number of multinational corporations use artificial intelligence to cover menial jobs, Wall Street is gearing for a once-in-a-lifetime change. 51% of the analysts at JP Morgan suggest that AI would have a major influence on trading. Investors all round are asking the same question. Could the rise of generative AI lead to the Wall Street ending as we know it? It is understood amongst the investors community that investing in the stock market can allow the average millennial the chance to earn as much as $3.3 million by the retirement age in the US. However, tapping into the stock market is a daunting and scary experience for a first-timer. That's where AI comes in. Artificial intelligence tools help level the playing field for users by navigating the data and incorporating fintech. A growing number of young adults in North America are hesitant to invest in mutual fund schemes due to its management costs. This out-of-date industry is controlled by 3 major companies. The monopolization deters young investors, and AI helps them with better alternatives. Companies incorporating AI in their investment tools include Robinhood, Vanguard, JP Morgan Chase, and Wealthfront. These AI strategy developers allow the casual investor to benefit by identifying wise moves. The retail investor is afforded features like portfolio diversification and automatic rebalancing to protect gains in the midst of inevitable market volatility. All this is achieved for less money than what the average Wall Street analyst charges. Jens Nordvig, a former staffer at Goldman Sachs, came out saying that with AI, it is possible to create bespoke information for clients through automation. This puts the salespeople at investment banks at risk of losing their jobs to AI. This means that AI increases the number of people influencing the stock market, which could be positive or negative. Investing in the stock market isn't just for the wealthy anymore. With apps and AI making it accessible to invest with just a few dollars, the layperson can access the potential financial freedom of investing. Artificial intelligence's market share could go as high as $76.4 billion by 2025. Trading as a whole is undergoing major shifts. The online trading platform market stood at just over $8.8 billion in 2020. This is projected to grow to over $12.1 billion by 2028, growing at over 5% compounded annual growth rate. Such change has been made possible by the use of artificial intelligence tools. HSBC, the British financial services giant, was one of the first to reveal their AI chatbots in 2021, which provided instant analytics and insights for Forex traders. On the other hand, AI developments in trading also included the VWAP algorithm by Empirica, which allowed users to transact bigger orders without being overburdened by the market prices. Such changes have allowed greater use of technology in trading. Well-established institutes now often rely on in-house robo-advisors which monitor millions of data pointers simultaneously. For example, Traxon Traders, a capital market firm out of India, is using 3 AI-powered engines in their automated trading platform to allow traders a host of options that weren't available to them otherwise. Safe to say, the landscape has been shifting for quite a while. An analysis of the algorithmic trading market suggests that a massive 10.5% CAGR per annum is expected between 2018 and 2028. This market has been one of the finest case studies for the growth of AI and technology in the finance world, as algorithmic trading relies on the best computational capabilities for the best outcome for traders. In simpler terms, faster computers equal bigger profits. The time to conduct a trade has essentially been reduced to nanoseconds. And with up to 73% of all equity trading in the US involving algorithms of some sort, its importance cannot be sidelined. Some of the primary reasons behind the utilization of the algorithms include increased trader productivity, reduced market impact, consistency of execution performance, ease of use, and low commission rates. Their importance skyrocketed during the COVID pandemic, as there was a need for more advanced routing and electronic algorithms to assist and offer liquidity for traders since there was no other way for geographically diversified trading to function effectively. Large-scale institutional investors are benefiting the most from this, as they employ several computer-driven algorithmic tactics daily in the volatile trading markets that power the stock market. These strategies allow investors to lower trade expenses and increase their profitability. These traders often trade more than 100,000 shares at once. Algorithmic trading allows them to divide their capital and invest in portions, diversifying their risks. Automation of processes reduces overtrading dramatically, because some traders buy and sell at the first indication of a trade window opening. These techniques lessen the possibility of errors brought on by people. It responds to marketing conditions in a split second, making it a desired investment option. Leading the way in the algorithmic trading global market are companies like Sentient Technologies, who operate a hedge fund that built an algorithm processing millions of data points to find trading patterns and forecast trends, using artificial intelligence. North America is expected to drive the trading market as they have the most liquid capital available. An increasingly higher share of investors from the US put their funds in blockchain trading technologies every year. They also have the highest level of government support behind them to push for changes to dominate the international trading market. ETFs or exchange-traded funds have also become extremely popular with the portfolio investors. This is because ETFs are mostly index funds which incur lower expenses and don't require large security selections. These qualities make them a good choice to be managed almost entirely by computers. AIEQ, which is powered by the AI of IBM called Watson, is one such example of a portfolio actively managed by AI. Doing so, the fund consistently outperforms the S&P 500, making it a viable replacement to the traditional market. Another application of AI in managing portfolios is the introduction of AI advisors as stock pickers, to replace human advisors in actively managed equity funds. Investment management firms as major as BlackRock have indicated that robo-advisors will eventually replace human advisors. In a competitive market, AI removes the discretion which humans bring. As such, it is harder to be discreet. Active portfolio management is near impossible without relying on real-time data points, making AI models more desirable for management firms. However, despite BlackRock firing more than 30 stock-picking employees in 2017, they also posted record losses the same year after they relied on their robots. Improvements have been made since then, and the AI of today has become increasingly more accurate with their pattern recognition. Which begs the question, how does AI predict trade patterns? To put it simply, AI uses sentiment analysis, which is the process of gathering text and linguistics, and using natural language processing to identify patterns within subjective material. An AI trading system can gather information from news outlets and social media to determine market swings. It also takes into account past financial performance of assets and determines a course of trajectory for each asset. Online surveys show traders save up to 10% of their time with the help of AI like that. However, speed and efficiency can cause trouble for traders and markets. AI and technology has increased the number of HFTs, or high-frequency trading firms in the market. The HFTs flip stocks in such huge volumes and speeds that they distort all market signals. Back in 2010, the HFT traders caused the flash crash, where over $1 trillion worth of financial assets were wiped off and then restored on the market in a matter of minutes. Ever since, volatile markets have only become more normal. This is because HFTs operate at such high speeds that even a small change in market conditions leads to a massive shift in the signals and trades. Price stability is impossible to achieve in such situations. The intervention of AI in the stock market can also be seen in the way new stock trading companies are setting up. While traditional investment firms still dominate the trading market, we are seeing a number of revolutionary AI stock trading companies putting up big numbers as well. Let's take a look at a few of them. AlphaSense, based out of New York, helps investors research the market fast with its easily searchable platform. Collecting data from sources like Goldman Sachs, JP Morgan Chase, and Morgan Stanley, the company uses natural language processing and machine learning to go through market analysis reports and press releases. This data is turned into actionable advice for investing customers of AlphaSense. On the other hand, Imperative Execution Incorporation builds efficient financial exchanges with their team of engineers, analysts, and seasoned trading experts. Using AI to analyze stock prices and ensure price stability, their platform receives up to 200 million orders every day, and works with a variety of brokers. Orquin, a fully remote AI stock trader platform, gathers information via AI deep learning, and creates custom datasets from completely raw data. Orquin's platform is especially useful in uncovering lawsuits and sanctions on a firm, which can plunge the stocks of those companies once they are made public. Orquin's AI uses over 1 million sources, and provides solutions for asset management and risk management in a way traditional brokers cannot do. Firms like Canoe, Numerai, and Centio also pull in AI tools and derive huge orders on a regular basis, to create a market away from traditional brokers, which is faster, more efficient, and does the job of analysts at a fraction of the cost. Numerai used machine learning techniques to score gains of 20% in the last year, according to company data. Other firms like Trade Ideas employ robo-advisors to derive the most profitable scenarios for their customers. However, do Wall Street investment brokers and banks have a lot to be worried about? An assessment by Goldman Sachs suggests that as many as 35% of the jobs in financial operations are exposed to generative AI like ChatGPT. Marty Chavez, Goldman Sachs' former information operations chief, said that AI could do the work of about 9,000 employees at a time. Equity research is one of the most exposed sectors within finance. GPT-3 from OpenAI has been trained with the ability to decode the technical language used by the Federal Reserve. Wall Street investment firms already hire employees known as the Fed Watchers, whose job it is to predict the future monetary policy. Fed Watchers face imminent job security as a result of the advancement of AI. However, according to various analysts, GPT-3 doesn't quite match the expertise of human evaluation just yet. Since AI is still in its early developmental stages, it is largely believed to be more appropriate at handling less nuanced Wall Street tasks, such as company earnings projections or more fundamental industry research. An even greater concern for investment firms relying on AI is that the regulations are yet to follow. Since ChatGPT is still in its early stages of development, its regulation is also non-existent at the moment. However, many regulatory agencies have issued guidelines, principles, statements, and recommendations on AI. Federal agencies have gone as far as issuing a joint statement, warning of the escalating threat from fast-growth artificial intelligence applications. The SEC has indicated that it plans to issue a rule proposal on decentralized finance tools this year. These regulations will limit the use of AI by all businesses, including Wall Street investment firms. The SEC has hinted that it may even order firms to disclose when they've used AI in any business and financial operation. One of the reasons federal agencies have stepped in is to protect employee interest. The federal agencies fear a wave of unemployment might arise if they let investment firms use AI unsupervised. Moreover, AI like ChatGPT is not refined to provide unbiased and perfectly accurate results. Legal experts have warned investment firms on Wall Street multiple times that without robust rules on using AI, they could potentially fall into a lawsuit. Banks like Goldman Sachs, Citigroup, and Bank of America have outright banned the use of ChatGPT on their trading room floors. Most banks are citing privacy reasons for doing so. Many analysts suggest that there may be another reason for it. Generative AI, like ChatGPT, depends on past data to make future predictions. However, market crashes are quite rare and therefore there isn't much available data to train AI to predict a market crash. Big lenders are skeptical of using ChatGPT and other generative AI, since it is currently not fit enough to predict market crashes. A Wells Fargo spokesperson has come out saying that they are imposing usage limits on ChatGPT, as they continue to evaluate safe and effective ways of using technologies like these. JP Morgan suggested that their aim with banning ChatGPT was simply to reduce the usage of third-party software for business use. Put simply, one of the reasons ChatGPT fails to meet the needs of Wall Street banks is that it is built on over 175 billion parameters containing decades of data. However, investors only rely on a limited dataset to help them out, and therefore, Wall Street establishments, including hedge funds, train their own trading systems instead, often using pricing data. Moreover, macroeconomic factors keep varying from time to time. Political and economic situations alter human behavior in ways that cannot be tracked using language models, which were used to train ChatGPT or other generative AI. These language models cannot distinguish which dataset is going to have what effect on human behavior. While ChatGPT has proven to be impressive, it regularly makes the kind of obvious errors that can cost investors money and ruin the investment firm's reputation. Wall Street financial establishments chose not to rely too much on generative AI language models for this reason. To assume that AI would completely replace human traders and brokers in major financial centers like Wall Street is irrational. AI works best in situations where it enhances human understanding and increases human efficiency. Wall Street brokers work on mutual trust-based relationships which, as of now, cannot be replicated by AI technology. The human element is crucial, especially for investment banking or private wealth funds management. AI has also not been augmented to take the final decisions when trade decisions are being made. That authority still lies with the broker, who will be aided by the prediction models and suggestions of the AI tools. Within Forex trading, over 90% of brokers make use of one AI tool or the other. In comparison to expert advisors in Forex trading, Forex robots run independently from brokers and connect via APIs for order placement and trade management while operating without the trading platform. They generally execute without intervention if desired. However, even with little need to intervene, it is best not to be a casual set-and-forget trader to avoid losses. The automated Forex trade market is also notorious for scammers. Such issues in automation trading explain why the need for well-established Wall Street firms exists even today. As for traders looking to dive into cryptocurrency, AI trading bots are a great option for casual trading, since they enable non-professional traders to leverage profitable strategies. Automated AI trading bots in crypto use DCA short bots to borrow and sell tokens at the current price and buy them back at a lower price. Whereas DCA long bots are used to buy the natural dips and sell the spikes as the price rises over time, achieving a better average entry price for your positions. Among the most popular AI crypto bots are Krill, 3 Commas, and Crypto Hopper. Most of the AI crypto bots are compatible with major coins like Bitcoin, as well as major exchanges like Binance, all the while making crypto trading more accessible. The face of trading, whether it be stocks, crypto, or any other financial asset, is changing with the time, as AI expands its reach into brokerages and investment funds around the world. From enhanced data analysis and algorithmic trading to improved risk management and compliance processes, generative AI offers transformative benefits. However, it is important to recognize that while generative AI can replace certain traditional practices, human expertise and oversight will continue to be essential for decision-making and ethical considerations. The use of AI without ensuring proper regulations, privacy protections, and accountability measures is simply out of question. With federal agencies hinting at greater regulation coming our way, it's safe to assume that AI activity in the finance sector will be limited to some degree too. Wall Street, just like other financial centers around the world, is adapting to the change AI is bringing. It is important to understand that AI isn't here to replace humans, but rather to help us make more informed decisions with our finances and provide the greatest value in the most efficient way.